Hey, this is 1001 Investing Channel. We are here with tips and secrets about investing. So please pay attention to this audio. How to build your own signals. I turn bullish at the instant my buy stop is hit, and stay bullish until my sell stop is hit. Seykota. Just like builders use hammers and saws to build houses, traders use technical tools to build their own trading systems. You only need a few of these tools to begin to build your own signals, and in fact, you can have too many indicators that lead to confusion. The most important thing to keep in mind is that there is no one-size-fits-all solution. Some technical indicators work while markets are range-bound and others only work during trends. Many are useless during high volatility and crashes. No indicators work in all markets or under all conditions. Trading profitability doesn't come from a perfect indicator or a magic system, it comes from creating an edge over other traders and trading that edge to have more profits than losses over a long period of time. Your win rate will fluctuate as market conditions shift between uptrends, downtrends, range-bound, and volatility. Buy signals. Technical indicators that can be used to build your own buy signals. Price. Price versus previous day's highs and lows. Moving averages. MACD RSI. Chart patterns. Trends. Momentum. Candlesticks. Price gaps. Trading price action alone. Price signals can be breakouts of a price range over a set number of days, buy signals at 52-week highs, or sell short signals at 52-week lows in price. There are traders that believe price alone is the only indicator you need. Daily price versus previous day's highs and lows. Trading today based on yesterday's low or high price range is a day trader strategy. They also may trade the intraday range of support and resistance, buying the lows of the day or selling the high of the day short. Day traders like intraday volatility to give them opportunity to make money intraday on price swings and trends. Some swing traders set stops based on the high or low of the previous day's price range. Using moving averages. Moving averages are the average of prices over a specific time frame, and they can give a trader a better overall view of a trend. They are trend-following indicators and don't do well in range-bound markets. Moving averages can act as entries, exits, and trailing stops. Trend-following systems can be built based on moving average crossovers to create buy and sell signals. Single moving averages like the 200 and 250-day used alone in index ETFs can outperform buy and hold investing in the long term, for both higher returns and lower drawdowns in capital. MACD as a swing trading signal. The MACD, moving average convergence divergence, is a momentum indicator that shows the relationship between two moving averages of prices. The MACD is the difference between a 26-day and 12-day exponential moving average. A 9-day exponential moving average, called the signal line, is plotted on top of the MACD to show buy-sell opportunities. The MACD is profitable in markets with wide swinging price ranges. It is not useful in flat or markets with very tight price ranges. I have found the MACD to be the most useful as a swing trading indicator after crossovers. The moving average convergence divergence can work to show short-term reversals inside the longer-term trend for swing traders. It can be part of a filter for other signals or a signal in itself. RSI as a profit-taking strategy. Relative Strength Index, RSI, is a momentum oscillator that measures the speed and change of price movements. The RSI oscillates between 0 and 100. RSI is considered overbought when above 70 and oversold when below 30. Signals can also be generated by centerline crossovers over or under 50. Over 50 is a bullish cross and under 50 is a bearish cross. RSI can also be used to identify the general trend as greater than 50 is bullish and less than 50 is bearish. A breakout over 70 and a breakdown under 30 can also be used as a trend indicator. The relative strength index can show when price has become overbought or oversold, is due for a potential reversal, or the danger of something going parabolic as it breaks out. Chart patterns as visual trends. Chart patterns use trend lines to map out the buying and selling of market participants looking for trends and potential reversals of trends. Flags, pennants, triangles, cups and handles are examples of connecting the lows or highs in price over a time frame to establish a trend of higher highs, lower lows, or price ranges. Chart patterns can be bullish, bearish, continuation, or reversal patterns. Chart patterns are about connecting trend lines to identify potential breakout points for an entry to capture the next trend. Trends are your friend. Uptrends are defined as a market having higher highs and higher lows in a specific time frame. Downtrends are defined as a market having lower highs and lower lows in a specific time frame. Trends have to be quantified based on your trading time frame. Warren Buffett trades the longest-term trend. He bets on the capitalist system always driving up the prices on the stocks of the best businesses. A day trader may only be concerned with the next hour a stock is trading. The simplest way to make money in the financial markets is to identify the trend, quantify the trend, and stay on the right side of it in your time frame. There are many ways to do this. Momentum for fast profits. Moving fast in one direction with no sizable pullbacks is my definition of momentum. Momentum can cut both ways, leading to fast profit or fast losses. The best momentum is found at the beginning of a bull market as a stock breaks out to new all-time highs. The old all-time high is likely to become the new support. The stock could go on to increase 20% in price in a month or even double that year. Momentum works at all-time highs because everyone that is holding that stock has a profit and has no pressure to sell. There is no pressure from stop losses or trailing stops, only profit-taking pressure, which is usually light. Resistance levels for a stock making all-time highs tend to be whole numbers like $50 or $100 because this is where many traders set their profit targets. Momentum trading works best with new concept stocks that are innovative and have little competition. Candlesticks are for affirmation. Candlesticks are a graphic way of depicting the opening price, closing price, and trading range on a chart that is more visual than bar charts. While they are not signals by themselves, they are great for confirmation inside the context of a chart at key levels. A bullish candle off a key support level has more meaning than a bullish candle in the middle of a strong downtrend that doesn't converge with other bullish technical indicators. Sell signals. When you enter a trade, you will either exit with a big profit, a small profit, even a small loss, a big loss. Technical indicators that can be used to build your own sell signals. Stop losses. Price targets, trailing stops, ATR stops. Time stops. Stop losses. The point of stop losses is to make it highly unlikely that you will have big losses. In contract markets like options, your loss is limited to your position size. In the stock market, large gaps in price at the open can bypass your stop loss and give you a bigger loss than expected. Your position size is your first line of defense against big losses, and your stop loss is the insurance policy that limits your losses as a trade goes against you. A stop loss has to be placed outside the normal price action at a key price level that shows you are wrong, and not at the place that makes you exit out of fear. Your stop loss has to give your trade enough room and time to be right, not stopping you out before your trade is invalidated. Key places to set stop losses are a percentage below key support or resistance levels of price, moving averages, or key technical indicators like MACD crosses or moving average crossovers. Price targets are for maximum profits on the exit. Price targets should be set at levels where your risk-reward ratio has skewed against your trade and the odds of a reversal from an extended price level is greater than the odds of it going in your favor. Price targets can be set at key round price levels at overbought, oversold oscillator levels like the 70 RSI to exit longs, the 30 RSI to exit shorts, rallies back to key price support or resistance levels, or to key moving averages. Trailing stops allow your profits to run as far as they will go. A trailing stop is when you allow your stop loss to stay close as your trade becomes a winner. A short-term moving average is one way to do this. If your trade reverses back under the 5-day EMA or 10-day SMA, you would stop out. A strong trend could use the 5-day EMA and a trade with a wider price range could use the 10-day SMA. I like to use a close below a key moving average for my trailing stops so price confirms at the close, and I am not stopped prematurely intraday due to noise. You should be very careful with position size based on volatility to be able to hold to the close. Another trailing stop could be a loss of the previous day's low for long positions, or the break above the previous day's high for short positions. These can be intraday or end of day depending on your time frame. ATR stops get you out of a trade after a few bad days. The ATR % stop method can be used for any type of trade because the width of the stop is determined by the percentage of average true range, ATR. ATR is a measure of volatility over a specified period of time. Normally a high ATR indicates a volatile market, while a low ATR indicates a less volatile market. By using a certain percentage of ATR, you ensure that your stop is dynamic and moves with market conditions. Widen your stop in more volatile times and lower it in less volatile markets to keep from being stopped out too soon and to account for noise in price movement. Time stops frees up your capital for better uses. Time stops set a limit on how long you will wait for a trade to work before exiting and looking for better opportunities. It is stop loss on your opportunity cost. A time stop will vary greatly and may be hours for a day trader or months for a position trader.
Thanks for watching. I will upload a video every day with tips and solutions. So, for more, please like it and subscribe. It's free. Bye bye.